At a time when most stocks are on a downward spiral, one chemical stock defied the trend, hitting new highs every month. This company, a leading manufacturer of fluorochemicals and specialty chemicals, hit a 52-week high on March 17, 2025. Since January, the stock has surged an impressive 35%. The rally gained momentum at the end of December when the company reported strong Q3 FY25 results, fueling investor confidence. This upward trajectory is driven by robust financial performance, positive management commentary, and favorable macroeconomic tailwinds. Welcome to Bottomline. My name is Radhika Bajaj. In today's episode, we will analyze SRF Ltd, a leading player in fluorochemicals and specialty chemicals, including refrigerants, pharma propellants, and industrial chemicals. Now, before we dive into the company's financials, let's understand SRF's products and the business structure. The chemical segment contributes 43% of SRF's revenue and 69% of EBIT as of Q3 FY25. This segment consists of specialty chemicals and fluorochemicals. In specialty chemicals, SRF specializes in fluorine-based chemicals, producing active and non-active chemical ingredients for agrochemicals and pharmaceuticals. It also provides contract research and development services for major agrochemical and pharma firms. These are basically custom research and development services to develop and produce new chemical compounds tailored to the client's needs. SRF is also a top producer of pharmaceutical propellants that are used in inhalers and other medical applications, and it also produces various industrial chemicals. In fluorochemicals, SRF is a leading manufacturer of ozone-friendly refrigerants used in air conditioners and refrigeration systems. It has developed H32 gas, an eco-friendly refrigerant in high demand internationally. The company has large integrated factories that handle the entire production process from start to finish. SRF's packaging film business, the second largest revenue contributor, accounts for 40%. It produces transparent, metallized, and coated packaging films for FMCG, agro, confectionery, soaps and detergents, solar panels, labeling, and more. The third segment, technical textiles, contributes about 15% of revenue. SRF produces tire cord fabrics, belting fabrics, and industrial yarns for applications such as tires, seat belts, and conveyor belts. It commands a 40% market share in India's nylon tire cord segment and is a key global player in the manufacturing of conveyor belting fabrics. This diversified business model, global shifts in supply chains, and the China Plus One strategy have favored SRF. Consistent capital investments, R&D, innovation, and strategic acquisitions, such as its entry into the aluminium foil industry in 2022, have propelled SRF's growth. There are other business segments as well, including coated and laminated fabrics. Now, even though this segment contributes only 3% of the company's total revenue, it is a promising business segment for the company. Here too, SRF is a leading player. This, along with SRF's strong export business manufacturing in India, Thailand, Hungary, and South Africa, has helped the company carve a name in the industry. In fact, SRF caters to over 100 global markets. From this background, it is clear that SRF Ltd is a leading player in the chemical industry. Now let's try to understand what is leading to the SRF stock rally. Despite Nifty 50's decline, SRF Ltd has surged nearly 23% in the past 6 months. This was driven by early signs of demand recovery in Q3 FY25, beating industry estimates. The company reported a 14% year-on-year revenue growth, a 16% year-on-year EBIT increase, and a 7% rise in profit after tax. Management expects strong sequential growth in Q4 of FY25 and further improvements in FY26. After falling year-on-year over the last 6 quarters, chemical segment revenue returned to growth in Q3 FY25. The chemicals segment, previously hit by excess inventory and pricing pressure, witnessed a rebound in Q3 of FY25, prompting earnings upgrades from brokerages like MK Global Financial Services, Nuvama Institutional Equities, Motilal Oswal Financial Services, and more. Although the specialty chemicals segment, the core business for SRF, continued to experience some overhang of inventory in Q3 FY25, there appears to be a gradual spike in demand. But why did the chemicals industry struggle in the first place? Let's rewind 3 or 4 years back. India's chemical industry boomed during COVID-19. With supply chain disruptions in China, global and domestic companies scrambled for alternative suppliers, and Indian chemical manufacturers seized the moment. At that time, SRF Ltd had emerged as one of the beneficiaries. Between FY20 and FY23, SRF stock price surged 4.3 times. However, by 2023, the chemicals industry's momentum slowly began to fade, and by 2024, the rally had largely lost steam. The broad reason is well known. An oversupply of chemicals led to pricing pressures, squeezing margins across companies, including SRF. As sales volumes took a hit, SRF's revenue fell 12% year-on-year in FY24. EBITDA margins dropped from 24.9% to 20.9%, and profit after tax declined 38%. Another significant setback came from the refrigerant gas market, a major business area for SRF. The US regulations on hydrofluorocarbons, or HFCs, led to stockpiling in FY23 and demand collapse in FY24. In 2023, the US government introduced bans and quotas on certain HFC gases used in refrigeration to phase towards a better version of HFC. This led to companies stockpiling before the new regulations took effect. This resulted in an oversupply and a sharp contraction in refrigerant gas sales. All this has led to management revising its growth guidance to single digits from the earlier estimate of 20% for FY24. Also, the Russia-Ukraine war has added to the uncertainty. Despite these challenges, SRF continued its capital expenditure plans, positioning itself for long-term growth. Further, a few positive trends have helped soften the blow. India's import substitution strategy played a crucial role, with companies fully leveraging their domestic production capacities despite the influx of cheaper Chinese imports. Additionally, steady demand from the pharmaceutical and FMCG sectors helped stabilize revenues, while new product launches provided some relief from the broader slowdown for SRF. Now, post-December, with market conditions turning more favorable, the key question is whether SRF can sustain its growth momentum. SRF's long-term growth is backed by multiple factors, starting with rising HFC price to drive growth. Domestic demand for the R32 is projected to grow from 20,000 tons to 35 to 40,000 tons in the next 3 years up to 2028. With increasing air conditioner penetration and a shorter replacement cycle of 3 to 5 years, R32 prices are expected to rise further. R32 is a kind of HFC gas, and HFCs are synthetic gases used as refrigerants in products like air conditioners. They have a high global warming potential. At the same time, HFOs are a newer class of refrigerants designed as alternatives to HFCs with much lower global warming potential, and R32 is a better version of refrigerant. Globally, R32 and R22 prices are rising due to restricted supply and a shift to lower global warming potential gases. This favorable pricing is expected to continue through 2025. Also, chloromethane production has reached full utilization, and PTFE volumes are set to grow in FY26 as export approvals come in and new facilities begin operations in the second half of FY26. So these developments position SRF for long-term growth in the fluorochemical sector. Secondly, the company has a strong product portfolio. SRF's specialty chemicals portfolio focuses on branded agrochemicals with high margin potential. According to analysts, the total addressable market for these products ranges from $150 million to $450 million. The introduction of new products in specialty chemicals is expected to drive higher margins. In the specialty segment, the new active ingredients will start contributing significantly from FY26 and are expected to reach optimal utilization in the next 3 to 4 years. SRF aims to capture a 35 to 40% market share in this segment. In pharmaceuticals, SRF is collaborating with global innovators aiming to triple revenue within 3 years. The growth in fluorochemicals will come from new products, particularly in Europe and the United States. Margins in the chemical segment are improving and are expected to reach the guided range of 25% with a 2 to 3% variance. This is an improvement from the Q3 FY25 EBITDA margins of 19.9%, with further gains anticipated in Q4 and FY26. Thirdly, let's talk about Capex. The company plans to incur a Capex of 1,500 crore rupees in FY25 and between 1,500 and 2,000 crore rupees for FY26. FY26. There is a possibility of a scale-up in FY26 and FY27, provided the industry scenario normalizes by 2027, after which the management expects Capex to step up to previously expected levels of 2,700 to 3,000 crore rupees. As part of its Capex, SRF is investing around 1,100 crore rupees in fourth generation refrigerants or HFOs, with a new plant expected to be operational by 2027. According to analysts, while HFOs are used in smaller quantities than HFCs, their value is 20% higher. While exports of HFOs will begin in FY28, domestic adoption in India is expected after FY32. One point to note is that despite the Capex incurred in FY24, the company's net debt to equity ratio is 0.35 times, and it has remained at the same levels in Q3 FY25. However, the company is planning to expand more, and it could take on higher debt. Beyond its core chemicals business, earning stability in SRF's packaging film and technical textiles segments remains an important factor to monitor. Management is cautiously optimistic about the packaging film segment, expecting an improvement in the current demand-supply imbalance. There are three products offered by SRF: BOPP and BOPET. Now, both are flexible packaging films for different applications. And then there's aluminium foil. At present, this segment is witnessing a soft growth trajectory due to a supply-demand mismatch. The aluminium foil business is expected to improve going forward, as there was a margin pressure due to imports from China. The implementation of an anti-dumping duty should help the company see better business performance for aluminium foil. While the technical textiles business segment for SRF remains stable, it faces lower demand and margin pressure. Aggressive imports from China affects margins, increasing the competitive pressure in the market. That said, with SRF being the market leader in this segment, it can withstand the pressure in the near term. Though these factors work in SRF's favor, there are a few pointers to keep in mind. While SRF's growth outlook is strong, challenges remain. The Indian chemical sector is recovering, but sustained growth is uncertain. This will be a key factor to watch out for in the coming quarters. Another concern is the potential US tariffs on Indian chemical exports, which could impact profitability, with Citi estimating a 4% EBITDA impact on SRF if a 7% tariff is imposed. However, the actual impact may be lower due to possible offsets from tariffs on other exporters and potential price adjustments in the American market. While SRF and other Indian chemical companies could expand their presence in Europe, challenges remain, including weak domestic demand in the region. That said, investors should also pay attention to SRF's valuations too. SRF is trading at a lifetime high price to earnings multiple of 78 times against the historic median of 22 times. Even the market cap to sales ratio and EV by EBITDA ratio show that stock trades are higher than their historical median. For context, other leading specialty chemical stocks such as Gujarat Fluorochemicals Ltd are also trading at a much higher valuation of 93 times from their median PE of 42 times. Similarly, Godrej Industries PE is at 51 times versus its median PE of 23 times. As such, with SRF stock trading near an all-time high and the broader market having seen a correction, this could signal a revival in demand for the company's business. However, investors should remain cautious. If the expected recovery doesn't materialize, the stock could still be considered expensive. In this video, we have explored SRF's current market position, its ongoing recovery, past industry challenges, and future prospects. And we do hope you learned something new today. Do hit the subscribe button if you want to continue learning about Indian companies and their stocks. By the way, what's your take on SRF? Will it soar or will it stumble? Let us know in the comments.